I actually think this is a pretty interesting acquisition, and I don't think it disrupts the overall valuation of, well, we come into a Monday and the market is rallying, but we have so many things to talk about here. The main focus around what we're going to be doing going forward is definitely going to be GARP investing, and that's growth at a reasonable price. And with earnings now kicking back off on Monday, Google is definitely one of those names that's starting to get interesting when we talk about GARP. With all the bad publicity now surrounding Google, a recent letdown on cloud growth could be lending a pretty interesting opportunity here very soon. A lot of the times these antitrust cases for the big mega tech companies tend to be an interesting opportunity to be building into positions because a lot of times they can handle what's coming, and it's usually not as big of a deal as we all anticipated. And if you've been following the channel, the one thing I've really been talking about that I think is going to start taking place here is mergers and acquisitions. And this one is definitely in the wheelhouse. We have high interest rates and we have distressed real estate. So we're starting to see a company like Realty Income, a well-capitalized, pretty safe REIT here, now making an acquisition to acquire Spirit Realty for $5.3 billion. Now, this is going to be an all-stock transaction, which is going to give Spirit Realty shareholders 0.76 shares of Realty Income shares. And so when we think about the macro backdrop here of interest rates being elevated for longer, this is tying up commercial real estate to really have growth aspects. And mergers and acquisitions absolutely make sense here, especially in an all-stock deal. When we look at how REITs usually purchase property, they do dilute by raising capital by selling shares or issuing shares, and then they go to the capital markets, use conventional lending for the other half of the purchase. But what are we seeing with these higher rates? It's really hard for these REITs to have any sort of growth aspect here, and they definitely don't want to be selling or liquidating properties in a higher interest rate market because the cap rates are smaller and people are just not going to pay a premium for commercial real estate right now. We've been really pushing on this channel to basically stay away from the big brick and mortar banks, your traditional banking that don't have any unique value propositions. Along with that, we said commercial real estate is getting interesting, but we still want to hold tight here until we understand where rates are going to top out at. Now, this deal is expected to close in the first quarter of 2024. And the reason why Realty Income is making this purchase is, number one, they want to diversify their tenant profile. And number two, this is going to increase equity value for shareholders long term, as long as this purchase is good. Doesn't have to be perfect, it just has to be a solid purchase here. The fact that Realty Income is kind of been going off their normal path here, they're starting to invest in casinos. We're starting to see them take on a little bit more risk here with mergers like Spirit. And so while we're seeing the sell-off on Realty Income, we're seeing the tick up here on Spirit Realty. And this is a normal behavior when you get a merger like this. I actually am surprised at how much Realty Income is selling off because it's already fallen off pretty drastically with the rate hikes. This stock was trading for over $80 a share, down to roughly $46 a share. But let's just breeze over the finances here really quick. So I have some decent top-line revenue growth, and operating income is coming in pretty decent here. And we see cash flows coming in pretty strong here as well. They have a pretty low cash position here at $8.7 million of cash. You'd like to see a little bit more cash on this balance sheet. And total debt is sitting pretty much at $3.6 billion in debt. And so when we look at a forward funds from operation, trading right around 3 to 4 times forward funds for operations, and that's kind of what you base your valuation on REITs for. And so this stock was paying a heavy dividend of over 8%, mainly due to the fact that the stock price has fallen off pretty drastically here with interest rates on the rise. And they might have some floating debt out there that investors were pretty concerned about. And so could be multiple reasons why the stock was selling off. But when we look at the valuation of the stock, actually pretty cheap here. So just kind of breezing through what they currently own, they say they have $9.3 billion of real estate investments. Obviously, that's subject to what commercial real estate valuations are. But 345 tenants, they're free cash flowing a little over $450 million a year, over 2,000 properties in 37 industries. And when we take a look at the industries here, it does complement Realty Income's portfolio fairly well, I believe. And, I don't think these are companies that are really going to go out of business here when we look at some of these tenants. Now, all these tenants are not going to be as high quality probably as what we're seeing. They're going to put their best tenants out here for advertising purposes. But when we look at BJ's Wholesale, Circle K, Home Depot, gas stations, I actually think this is a pretty interesting acquisition. And I don't think it disrupts the overall valuation of Realty Income. I actually think that the sell-off could be a buying opportunity. If we get a big sell-off on this, I actually think this could be a pretty decent buying opportunity here. I don't think Realty Income is a screaming deal, But with this sell-off and with the recent acquisition here, I think there's some unlocked value that could be had when we look at a grander scale of adding that many more properties, that much more free cash flow. The problem I actually had with Spirit was the lack of cash on their balance sheet, the amount of debt that they're carrying, and then I do think Realty Income paid a little bit more than they probably should have. So one deal saying it's going to be a $5.3 billion deal and another deal saying it's going to be a $9 billion deal. And so where I thought fair value would be for a company like this trading, paying roughly 10 times free cash flow, I think makes sense, maybe a little bit more. I think a $5 billion deal makes sense. So I do think Realty Income did overpay depending on which deal, right one that is being publicized here. But I feel like under $5 billion makes a really good deal for Realty Income. Anything over $5 billion is kind of a little expensive here, which is now going to bring us to earnings here. With earnings now kicking back off, one of the companies I'm actually interested in kind of seeing here, one that I think the valuation's a little expensive and I want to see if they can grow into their valuation, is actually going to be Pinterest. This is going to be one I'm personally watching. And when we're talking about GARP, I feel like CVS is definitely in the wheelhouse here. This company is trading for roughly 7 to 8 times earnings. They have the ability to grow right around that 8 to 9 times earnings in my personal opinion. And where we're going to find this out is definitely going to be on the quarterly report here and what forward guidance is going to be. The forward guidance, in my opinion, is definitely going to be more important because we can see that the landscape is getting more and more competitive with now Amazon wanting to step in. And I want to hear what the CEO has to say about that. They can still be confident in maintaining that 6 to 8% growth rate, and they're trading right around 6 to 8 times earnings. This is in that wheelhouse of growth at a reasonable price. They return capital to shareholders by buybacks and dividends. So very, very interesting company. As most of you know, I am interested in this company. And when we talk about GARP, this does tend to fit in the wheelhouse. It just depends on, is this a value trap or can they really maintain high single-digit growth rates? Next one that's going to fall into that same kind of category is actually going to be PayPal. Now, PayPal has been doing nothing but selling off from $100 a share down to $50 a share. And this one, once again, is trading pretty close to that 8 to 10 times earnings and has the ability to actually grow high single digits once again, which is putting it in that wheelhouse. And just below that is going to be Qualcomm. This is one of your more value type chip plays, not getting the multiple that a lot of your other chip companies are getting. And once again, this could either be growth at a reasonable price, depending on what earnings are and what forecasts are going to be, or it could be a value trap, as we all know that the landscape is absolutely shifting pretty quick here for NVIDIA, taking up a big market share of what's going on. And the landscape is extremely competitive and unclear at this point in time, which could lend an opportunity for some of your contrarian plays like a Qualcomm. So with the markets up roughly 0.5% across the board, oil coming down here, making inflation a little bit more tolerable. Those are the 3 names that I'm going to be focused on over the next couple days to kind of see if they are falling in that GARP category or possible value trap plays. And how we're going to know that is through their earnings call and what the guidance is going to be and how confident management is to execute those high single digit growth rates. As always, appreciate everybody's time and we will see you in the next one.